China built enough empty apartments to house the entire population of France, and officials still call the housing market undersupplied. Ordos stands nearly silent at night, despite its glass towers and 6-lane highways. Tianducheng has its own scaled Eiffel Tower and almost no residents. This pattern repeats across dozens of Chinese cities, and it is not an accident or a planning failure. Every one of these cities exists because of a single financial mechanism that powered China's rise for 30 years. By the end of this video, you will understand exactly why China built cities nobody moved into, and why stopping that machine now might be more dangerous than continuing it. In the early 2000s, a local mayor in provincial China faced a familiar problem. His city needed roads, schools, and hospitals, but Chinese law banned local governments from borrowing money directly. So officials created something new: local government financing vehicles, shell companies that could legally borrow on behalf of the city. These vehicles took out loans, then used the money to buy land from farmers at low prices and sell it to developers at much higher prices. The profit funded roads, subway lines, and stadiums. For a while, the system worked brilliantly. Rising land prices covered the debt, growth attracted more residents, and more residents pushed land prices even higher. But growth targets kept rising every year, set by Beijing and enforced through promotions for compliant officials. Local governments needed more land sales to hit those targets, so they built more housing to sell more land, whether or not anyone needed the housing. Developers like Evergrande borrowed aggressively to build faster than any city could absorb, betting that Chinese buyers would keep purchasing apartments as investments rather than homes. Millions of Chinese families did exactly that, pouring savings into apartments they had no intention of living in, because property prices in China had never gone down in living memory. Therefore, an entire economy, local governments, developers, banks, and households became financially dependent on land values rising forever. The mechanism holding this entire system together is called land finance, and it works like a chain of dominoes. Local governments don't collect much income tax, so they rely on selling land use rights for revenue, sometimes generating over a third of local budgets from land sales alone. When a city sells land to a developer, that developer needs financing to build, so it borrows from banks and shadow lenders, counting on future apartment sales to repay those loans. When apartment buyers purchase units before construction even finishes, a common practice in China, they are effectively lending money to developers directly. Every layer of this chain depends on the layer above it selling successfully, meaning if home sales slow down, developers can't repay loans, which means banks face losses, which means local governments can't sell new land at high prices, which means city budgets shrink. This single chain reaction explains why one struggling property giant like Evergrande can threaten an entire financial system. Evergrande's $350 billion in disclosed liabilities didn't just affect its own balance sheet. It froze 1,300 unfinished construction projects across 280 cities, leaving home buyers who had already paid without apartments and local governments without expected land revenue. Here is the twist most people miss entirely. China's local government debt problem is partly a crisis Beijing created on purpose to fix itself. Since 2015, and again after 2020, the central government has repeatedly launched deleveraging campaigns designed to force local governments and developers to stop overborrowing. Each time, growth slowed sharply, so Beijing quietly reversed course and loosened lending again, restarting the same cycle. In November 2024, Beijing launched a 10 trillion yuan debt resolution program specifically to help local governments manage this mountain of hidden LGFV debt, an amount larger than the entire GDP of countries like Canada or Italy. Yet, independent estimates from the IMF suggest actual LGFV debt has kept climbing anyway, reaching roughly 71 trillion yuan by the end of 2025, even after Beijing's rescue effort. In other words, China is spending trillions of yuan to manage a debt problem that keeps growing faster than the rescue can shrink it. A paradox almost no coverage of this story explains clearly. China cannot simply write off this debt the way Western economies sometimes do, because the debt isn't concentrated in a few isolated banks. It runs directly through household savings. The vast majority of Chinese household wealth is tied up in real estate, a share that dwarfs equivalent figures in the United States or most of Europe. Meaning, a serious property price collapse doesn't just hurt developers, it wipes out ordinary families' life savings. This is fundamentally different from the 2008 US housing crash, which was driven by risky mortgage lending to overextended private borrowers. In China, the state itself, through local governments and state-owned banks, holds much of the risk directly. It also differs from Japan's lost decade, where a stock and property bubble burst and deflation followed for years, because Japan's households and banks had far less direct exposure to local government financing structures than China's do today. Beijing's dilemma is that stimulating growth again risks reinflating the same bubble that caused this problem, while allowing prices to fall risks a slow bleed through the entire financial system for years. Right now, the honest assessment sits between manageable correction and slow-motion crisis. Growth has genuinely slowed, but Beijing retains enormous control over its banks, its currency, and its capital flows compared to a typical market economy, giving it more room to manage decline gradually than most crisis narratives admit. What happens in China's property sector over the next few years will shape global commodity markets, emerging economies tied to Chinese demand, and household confidence for over 1 billion people. The open question nobody can answer yet is whether China can shift its entire growth model away from land and construction before local government debt becomes unmanageable, or whether the shift itself is what triggers the crisis everyone has been trying to avoid. If you want to understand the systems that quietly decide how national economies actually work, subscribe to WorldStages, because that's exactly what this channel breaks down every episode. So here's the real question worth debating. Is China's debt problem a uniquely Chinese story? Or is it a preview of what happens to any economy that grows by borrowing against its own future?